Listen, if you're collecting Social Security or planning to in the near future, what I'm about to share could put hundreds, even thousands of extra dollars in your pocket in 2026. I'm John from Dream Visa Updates, and I've broken down 6 major Social Security changes that kick in next year. Stay with me because by the end of this video, you'll know exactly how much money you're getting, how much you're paying, and most importantly, how to keep more of it. Every January, the government tweaks Social Security like clockwork. It's their annual tune-up. But 2026? These aren't just minor adjustments. We're talking about real money hitting your bank account, real taxes coming out of your paycheck, and real strategies you need to know right now. So let's dive into what's actually happening with your benefits. Change number 1, the COLA increase. COLA means cost of living adjustment, and for 2026, you're getting a 2.8% bump if you're receiving Social Security or supplemental security income payments. That's up from 2.5% in 2025. Now, before you get too excited, let me give you the reality check. The Social Security Administration says the average retirement benefit will go up by about $56 a month. We're talking $215 to $271 starting with your January 2026 payment. If you're getting that average check right now, this 2.8% COLA translates to an extra $672 per year. Look, I'm not going to sugarcoat it. That's not life-changing money, but it's something. Now, change number 2 affects everyone still punching the clock. Starting in 2026, the taxable wage base is climbing. In 2025, that cap sat at $176,100. For 2026, it's jumping to $184,500. And yes, your employer pays more too. This is a straight-up tax hike for high earners. It doesn't change the 6.2% you pay. It just applies that 6.2% to a bigger chunk of your income. Self-employed folks, you're still paying the full 12.4% in Social Security tax. Now, if you make less than $184,500, this doesn't touch your paycheck at all. But for high earners, you could be paying an additional $520.80 in Social Security tax in 2026. Here's the silver lining, though. After your income hits above $184,500, you stop paying into Social Security. So if you're making $200,000 a year, you'll actually get an extra 6.2% back in take-home pay come November or December because you've already maxed out that $184,500 cap. Your payroll just stops taking Social Security contributions. Makes sense so far, right? Change number 3. The new $6,000 senior deduction that started in 2025 continues into 2026. But hold on, because there's a massive misconception I need to clear up right now. People think that as long as you collect Social Security, you automatically get this $6,000 senior deduction. Wrong. Dead wrong. This is for people over the age of 65, not when you start collecting Social Security. So if you're collecting at 62, you don't qualify for this deduction. Let me explain why this matters. First, understand that a deduction is different from a credit. A credit is fantastic because it reduces your tax bill dollar for dollar. A deduction is just good. It reduces the amount of your income that gets taxed. So what's a $6,000 deduction actually worth? If you're in the 12% tax bracket, it's $720 in your pocket. That's $6,000 times 12%. Look, it's real money, and I'll take $720 over nothing any day. But it's not a $6,000 check showing up in your mailbox. Second, and this is crucial, this new deduction stacks on top of your other deductions. You get the standard deduction. You get the existing senior bonus that people over 65 already get, which in 2026 is $250 if you're single or $1,650 per person if you're married. Now you add this new $6,000 senior deduction on top of all of that. It's a triple stack of deductions working in your favor. Let me show you how this plays out in real life. Say you're 67 years old and single. With this new $6,000 senior deduction, you've got 3 deductions working for you. First, the standard deduction for any single person in 2026 is $1,600. Second, the existing senior bonus for being over 65 is $250. Third, the new senior deduction is $6,000. Add those up and you've got $2,450 in total deductions. So picture this. You're 67, recently retired, and your adjusted gross income from your pension, your 401k withdrawals, and taxable Social Security is $60,000. You subtract that $24,150 from your $60,000, and that leaves you with taxable income of only $35,850. That's what you actually pay taxes on. Using the progressive tax system, the first $12,400 gets taxed at 10%, which is $1,240. The next $23,450 gets taxed at 12%, which is $2,814. Add those together and you owe about $4,054 in federal income tax. That's roughly $338 per month. Compare that to the old system. That $6,000 senior deduction alone saves you $720 in annual taxes if you're in the 12% bracket. If your income pushes you into a higher bracket, that deduction saves you even more. This is a big deal for managing your retirement taxes. But wait, here comes the fine print. This is the government we're talking about, so of course there's a catch. That $6,000 deduction isn't for everyone. It starts phasing out once you hit a certain income level. If you're single, you get the full $6,000 as long as your income stays below $75,000. But between $75,000 and $175,000, that deduction starts shrinking. Once you hit $175,000 in income, the $6,000 senior deduction vanishes completely. Keep in mind, the difference between $75,000 and $175,000 is $100,000. That's your phase-out range, and it's an important number for calculating where you stand. Let me give you an example. Say you're single, over 65, with a modified adjusted gross income of $100,000. The phase-out starts at $75,000, so you're $25,000 into that range. Take that $25,000 and divide it by $100,000, the size of the phase-out range. That gives you 0.25, or a 25% phase-out. Apply that 25% to the deduction. 25% of $6,000 is $2,500. This means your $6,000 deduction gets reduced by $2,500, shrinking to $4,500. You're still saving money, just not the full amount. Change number 4, the Social Security Earnings Test. This one matters if you're thinking about working while collecting benefits before you reach full retirement age. In 2026, if you're under full retirement age for the entire year, you can earn up to $24,480 before Social Security starts cutting your benefits. That's up from $23,400 in 2025. If you earn more than that limit, Social Security withholds $1 in benefits for every $2 you earn over the limit. Let's say you're 64, collecting benefits, but also working part-time making $30,000 a year. That's $5,520 over the limit. Social Security will withhold $2,560 from your benefits. Now here's something important. That money isn't lost forever. Once you hit full retirement age, they recalculate your benefit and give you credit for those withheld months. It's not ideal, but it's not gone permanently. If you're hitting full retirement age in 2026, the limit is much higher. You can earn up to $65,160 in the months before you reach full retirement age, up from $62,160 in 2025. They only withhold $1 for every $3 you earn over that limit. And once you hit full retirement age, there's no limit at all. You can earn as much as you want without any reduction in benefits. Change number 5 is about qualifying for benefits. This is more for younger folks, but it's still worth understanding. To qualify for Social Security, you need to earn 40 credits over your lifetime. In 2026, you earn 1 credit for every $1,890 in covered earnings, up to a maximum of 4 credits per year. That's $80 more than the 2025 level. So if you're still building up your credits, you need to earn at least $7,560 in 2026 to max out your 4 credits for the year. Most people hit this pretty easily over their working life. But if you've got gaps in your work history or you worked mostly cash jobs that didn't report to Social Security, keep an eye on this. Change number 6 is about Medicare premiums, and this one stings. Medicare Part B premiums are jumping to $26.50 per month in 2026. That's an 11.6% increase from $185 in 2025. Most people have their Medicare premiums deducted straight from their Social Security checks. So remember that COLA raise you got? A good chunk of it gets eaten up by higher Medicare premiums. You might get that extra $56 a month from COLA, but then you're paying more for Medicare, and suddenly, that raise doesn't feel like much of a raise at all. It's like getting a promotion at work only to find out parking fees went up. Speaking of Medicare, if you're in the annual enrollment period right now, which runs from October 15th to December 7th, this is your time to look at your coverage and see if changes make sense. Maybe you want something cheaper, or your health situation changed and you need different coverage. Maybe your prescription drug costs went up, or you're not happy with the quality of care in your network, or you just want to simplify everything into one plan instead of juggling multiple policies. If any of these apply, shop around now. You've got until December 7th to make changes, and whatever you pick kicks in January 1st, 2026. Here's my take on all of this. Social Security isn't the most exciting topic in the world, but it's probably one of the biggest pieces of your retirement income puzzle, so it's absolutely worth understanding. These 6 changes coming in 2026 might seem small individually, but they add up fast. That COLA gives you a boost. If you're 65 or older, you could benefit from that extra $6,000 senior deduction. The earnings test affects anyone wanting to work and collect simultaneously. Credit requirements keep adjusting. Medicare premiums keep climbing. It's all connected, and it all matters. So take the time to figure out where you stand. Run the numbers. If it gets too complicated, talk to someone who can help you sort it out. This is your money, your retirement. You worked too hard for too long to leave money on the table just because you didn't understand how the system works. I'm John from Dream Visa Updates, and I hope this breakdown gave you the clarity you need to make smart decisions about your Social Security in 2026.